Hi, I'm Ray Vars, a partner and senior portfolio specialist at Harding Loevner Asset Management, and I appreciate the opportunity to speak to you today at the annual general meeting. As we were recently appointed as a manager, I wanted to provide a quick reminder of our approach before diving into recent performance, our current thinking, and positioning of the portfolio. So we invest in high quality, growing businesses, regardless of where they are domiciled, identified through deep, fundamental, bottom-up analysis. We pay attention to the price we pay for those companies, and we manage a diversified portfolio. And by building that diversified portfolio of high quality, growing businesses, we've achieved very consistent outperformance in the long run. And have done so since we started more recently managing PIA. We began managing in May, so the first full month of management was June. And looking at performance for the trailing 4 months, June through the end of September, the fund was up 9.5% in Australian dollars versus the MSCI World up 8.8%. While most sectors and regions rose in Australian dollars for the last 4 months, China was a notable exception, dropping 12% and dragging down emerging markets to be the only negative region around the world. Looking on a sector basis, COVID winners in the technology and healthcare space were once again leaders in the performance. In the last 4 months, though, they were joined by energy stocks, which rose with rising oil prices and hopes for continued economic recovery looking ahead. So how have we outperformed in this period? Much like our long-term track record, it's been driven by strong stock selection, both in a sector basis or a region basis. Looking first by region, China, like it was for the general market, was the biggest relative negative for the period for our portfolio, where we had a number of holdings down more than 20%. But more than offsetting that was very strong stock picking in developed markets in Europe and Japan, but particularly in the US. Technology stocks like NVIDIA, the chip business, or EPAM, which is an IT consulting services business based in the US, headquartered at least, but with software engineers around the world, particularly in Eastern Europe, performed very well. They were joined by healthcare companies like Edward Life Sciences in the US, but also healthcare companies in Switzerland like Alcon, or in Japan, Sysmex, a testing business. They were all strong performers, and those also helped drive strong stock picking on a sector basis, particularly within tech and healthcare. Chinese companies weighed on a sector basis as well in communications, where those businesses that were hit by some of the regulatory reform that I mentioned before fell. But before I dive further into some of those Chinese names, I sort of wanted to take a step back and talk about some of the other issues on our mind as we sort of survey the global investment landscape. And I'm sure some of these things are on your mind too. There's a lot of talk about COVID, obviously, and inflation. And I think that a lot of what we see is, could almost be characterized as maybe COVID indigestion, and there's a lot of different symptoms that come with that. Some of it is disruptions we've seen in global supply chains, rising labor and energy costs, and clearly that's leading to some concerns of inflation. And the key is that temporal? Is that going to be something that fades as those sort of disruptions work their way through the system? Or is this a new normal where we're going to see higher inflation, higher rates for a longer period of time going forward? Clearly, if we do see that, that could be a headwind to the portfolio. High quality growing companies tend to trade at pretty rich valuations, and those could compress if we see higher interest rates persist for a long period of time. Of course, offsetting that is the fact that we think we're invested in a lot of great businesses where we see a lot of strength and continued strength and innovation across many different sectors of the global economy. And so those shorter term headwinds, those macro headwinds, which may create dislocations, we see those as opportunities when taking a long-term perspective. And that's how the portfolio is really compounded value in the long run, both by owning high quality businesses that compound that growth, but also staying focused on that long-term horizon. So when we see dislocations, often macro related, we're not afraid to step in and invest in a company where the stock price we think has been unfairly hit in the short term. And so again, we see those secular trends continuing of digital transformation. It's not slowing down. We've talked before and written about in our letter, if you look at that, the golden age of sort of healthcare innovation. And I can touch on some of that and how we're positioned in the portfolio later. So we really like the fundamentals of many of those secular winners. With that, maybe I should step back and dive a little deeper into China, given it's about 10% of the portfolio and was the source of some of the underperformance in the short run. Of course, as the market I mentioned has fallen about 12% in Australian dollar terms, we've actually, some of our names have held up a bit better in the high quality growing areas of China. Of course, we had some that were hard hit, like Country Garden Services, which is a real estate business, but I should distinguish it very much from Evergrande and the property developers that are facing a liquidity crunch and have been missing interest payments, and we think is a real challenge for those businesses going forward. Country Garden Services was not immune, I think, just because it happens to be in the sector, but they focus on providing services, and it's not only an area that we think the government wants better quality for many of the middle class that they care about. It's part of the common prosperity goals of the government. So we think CGS is actually well positioned there, Country Garden Services, not only because some of what their business is aligns with the government's goals, but also it's a highly fragmented sector that it's taking consistent market share both through acquisition and organically. So we think this is a sort of an example of a short-term hard-hit business that's being caught up with sort of macro concerns that we see a long-term opportunity when you really dig down deep into the company and what the real drivers are. Another area, innovation, what I talked about before, particularly in healthcare. One of the recent purchases in the portfolio, Wuxi AppTech, certainly sort of hits on this in particular. They're a contract manufacturer, so healthcare companies around the world, pharmaceutical businesses around the world, as well as within China, would outsource development and manufacture of small molecule drugs to Wuxi AppTech. So those are pills, for example. And Wuxi AppTech's actually a sister company of Wuxi Biologic that we own, which is also a contract manufacturer, but for biological drugs. And that's where a lot more of the emphasis and growth and excitement has been, while small molecules have sort of been forgotten. What we see with Wuxi AppTech is actually they have great IP on that front, and more companies are continuing to outsource for them. So there is still rapid growth on the small molecule side, but Wuxi AppTech has also sort of leapfrogged from that over biologics and gone for the next big thing of gene and cell therapy. And I guess Peter Bond, one of the portfolio managers, likes to make an analogy. If you think about small molecule drugs or the pills, the relative complexity compared to biologics and gene therapy, a pill would be like a bicycle in terms of complexity, whereas biological drugs are like moving to building a car, whereas gene and cell therapy is the complexity of manufacturing an airplane. And when you think about that, there's a lot of innovation there to come. Wuxi AppTech is well positioned. So they're taking the cash flow and earnings they've been generating in the small molecule side and reinvesting in that gene and cell therapy, where they're really a clear leader, looking not just in China, but across the world. And that's pretty exciting. When we look at China, not all of the companies are well positioned going forward. And so we have to acknowledge some we let go recently. For example, Alibaba, very strong business. Obviously, regulatory concerns are something people point to with Alibaba, and certainly they've been a target of the government along with a lot of e-commerce businesses. But that's not really why we let it go. Our concern was actually rivalry. So companies like Meituan, Pinduoduo, some of the smaller competitors have been more agile and have been investing in areas that are causing Alibaba to have to invest as well. And we think that may pressure margins and potentially longer term growth for a company like Alibaba. So enough on China. Looking beyond that, we're excited about a lot of names. Again, in technology and innovation, a company like Applied Materials, AMAT, that we added to the portfolio, US-based tech company that we think is a real complement to ASML that we own in the semiconductor space, as well as NVIDIA and Synopsys, another business. AMAT actually helps with sort of that next generation of chip manufacturer where ASML has been helping TSMC, Intel's of the world sort of shrink the chips with their production equipment. AMAT is helping sort of stack those chips and turn those into three-dimensional chips. And sort of that's what you need to do to pack more computing power on a chip. So they're well positioned for that long-term growth. And it's almost like we have a suite of semiconductor businesses that are all well positioned. When you lump AMAT with ASML, with, as I mentioned, NVIDIA holding, but also Synopsys that I mentioned, which does software for design of chips. So you sort of have the design, the equipment to manufacture, and then the chip company itself and NVIDIA. And we think that those are very well positioned as semiconductors and their use is only going to continue to accelerate from our perspective. So stepping back to look at the portfolio as a whole, we haven't made any big changes to the structure of the portfolio, and I wouldn't expect that going forward. We go stock by stock in making our decisions. The portfolio continues to be very overweight healthcare. We're excited about that innovation that I talked about, particularly with Wuxi, Aptec and Biologic, but many other companies like Edward Life Sciences, Sysmex. So there's a lot of great businesses around the world, and we're very overweight there. IT, we're overweight, but can't really put much more to work there. We have a 25% maximum by sector. So we're sort of nearing that in tech. The two areas where we're overweight on a regional basis are the US and emerging markets, really driven by our exposure in China. Again, there's a lot of great innovation, and those are the types of companies we want to own regardless of country, regardless of sector. But we are mindful of price. So if you look at sort of what the biggest stock was a few months ago in the portfolio, and actually over the last couple of years at Harding Loevner, is PayPal. It's still a top 10 holding, but it's just 2% of the portfolio today. We've trimmed that because of valuations. And you see other companies, actually 2 of the top 3 holdings in the portfolio happen to be US-based financial services businesses, First Republic Bank and Silicon Valley Bank, 2 of the only, from our perspective, really growing financial services businesses around the world, high quality, generating high returns. But I think that highlights that we're able to find quality growing businesses across many sectors, not just in tech and healthcare. So, in the end, the portfolio may be exposed to some macro headwinds, but we really like our holdings. And as I mentioned, we're going to take advantage of dislocations to add to some of those long-term winners. So thank you again for the opportunity to speak to you today. And we greatly appreciate the trust you've placed in us to manage your assets. So thank you.